Hi, this is Randy Finney with the Right Side of the Chart, and today is Monday, February 14th, 2022. It's 2:04 p.m. Eastern Time as I'm starting the video, so we've got a couple hours to go in the trading day, and I just want to do a brief update. And what I'll talk about is do an update on QQQ. I did make sure to get a chart out to you guys this morning with what I thought were the most salient, technical developments or features to watch in the charts. That would be both the downtrend line and the bear flag that I've mentioned on the 60-minute. We'll go over that real quick. And then I'll do updates on, we'll talk a little bit about, the market, what I expect from here. And then updates on some of my favorite sectors right now. Obviously, it's been pretty clear. I've been bearish for a while, looking for more downside. So I'm going to go over some of the sectors that stand out, and that'll include the home builders, the semiconductors, the REITs, financials, even energy. And then I also want to just look at the bond market real quick, not just treasuries, which I talk about a lot and cover, but also junk bonds and high quality corporate bonds, because that's really like one of the last check marks that I've been waiting to see, and that is a divergence in credit spreads, an increase in credit spreads, and that's the difference between what investment grade bonds are paying, or treasuries really is what they benchmark against, and low quality corporate bonds. All right, starting out with the bear flags, same 60-minute chart I got out to you this morning, and I had a downtrend line here and gave you a couple potential, if it should we had broken out and got a couple, that was again, this is the candle that we had. That's why I said one or two solid 60-minute closes. That was not a solid. We barely got above it. It popped intra-period, and again, this is why trading a 60-minute time frame, you don't jump the gun on a breakout right as it occurs. You want to see if there's follow through, and there wasn't. And this is beautiful price action. This is what I love to see. I always, from time to time, you'll hear people say, "Oh, don't just trade the charts. Don't trade where you think things are going." You have to. My trading style, you have to have a bias in the market at times if you're going to engage it, and you can sit there and trade chart patterns, but if you don't have an overall bullish or bearish bias on a stock or a commodity you're trading, it makes it difficult. And what I mean by that is, in other words, in a bear trend, if I'm expecting more downside on a rally back to resistance, that's where I'll look to short instead of positioning for breakout. If I'm bullish and I think whether we're in a downtrend that looks like it's over and I'm looking at a bottoming play, and then a rally up to resistance, I'll wait instead of shorting that bounce into resistance. I'll wait for a breakout and go long. So at this point in time, the takeaway is that you look to short rips into resistance. So had we broken out and ran up to that first level there at about whatever it was, 353, that would have been objective short, as would have that one. But you could see in that post I sent out this morning, I had the bright arrows on my preferred scenario. That's when I give you those charts. This was the brighter color, bigger, thicker arrows, and then I had the smaller ones showing the potential alternative scenario. That's what that means. So here's what happened. We broke out. Again, it was a really nice and clean, well-defined downtrend line. Look at each and almost all of these candles here, tagging there, and then we hit it there. And then we broke out, and again, we all see what we want to see. Bulls saw a breakout of a downtrend line. And so that's a bull trap. They just got sucked in, and then boom, big reversal. Now look. Nothing's guaranteed, but right now, as I speak and do this video, there's a live chart. That's exactly what you want to see. So that was also an objective short add-on. All right, here on the break of the bear flag, also when the downtrend line was taken back, and that impulsive candle on expanding volume, that's exactly what you want to see on a bear flag. You had a bear flag, recently back here too. This is what they look like: impulsive leg down, followed by a level consolidation that takes form of a flag. Followed by another leg down. That one exceeded the measured target. And so I gave you the measured target on this one. I was using that point right there, but you can even use this candle right there, and that again gives you whatever I told you it was today. I added it on the chart. You just take a trend line, go down to the bottom there, add it down, and again, it gives you an approximate target. And then what I like to do is jump out, and if I don't have it on here on the 60-minute chart, I don't have any lower levels marked because you got to go pretty far back, then I'll go out to the daily chart and see if it aligns with support levels. So we'll see if there's follow through, but as of now, trading what is apparent, and that was that objective short entry right there. And one more thing on that is, I issued in the last couple weeks here, couple months, I did all the videos talking about the various sentiment indicators, building a strong case for not just a correction, but put, on pretty much what I call a crash warning, using the analogy between tornado and hurricane warnings in a watch. And we're on, have been and remain on a warning. As much as we've dropped so far, it's only been a correction in the NASDAQ 100 and the S&P 500. And the indicators that I was looking at, there's our correction right there. Um, the indicators still have an elevated risk, a substantially elevated risk of, again, a crash. When I define crash, let's just say it's going to be another leg down. We've already dropped 17%, and a crash would be a swift drop, as or even more swift than the previous drop down. That would be considered by most a market crash. And then just to loop out to the longer term, the weekly chart. Remember, we had highlighted the bear flag there on the weekly. These two candles, a little bit of counter trend bounce off of the first target, T1, which was hit right here. Impulsive leg down. And then last week, we had an impulsive breakout down below the flag. So that's a check mark. That's the sell signal. That's what you want to see, an impulsive move out. So far, additional selling. And that gives us the potential for, again, that relatively swift move. And so if it happens, and it happens relatively fast within a matter of just a few weeks, let's say, then that would be another 19% drop from the recent highs right here in the counter trend rally. And again, that would be by most metrics considered a market crash. It would also be a drop if my second target's hit of about 26, closer to 27% drop in the Qs. And at that point, it will, at least media will talk about it being a bear market, at least for the Qs, and then we'll see what S&P 500 does. Again, you're going to get more bang for your buck in QQQ and IWM shorting on the downside, I believe. And just to update that on SPY, here's a SPY weekly chart. Remember, bigger picture had two trend lines. I had on the weekly, I had this one, which was broken there. And that's when, no, it was right here when the NASDAQ 100 topped. S&P made a marginal new high, went back tested that first trend line, finally took out the secondary trend line, and then to me, the big sell signal came when we finally broke this trading range there. And then to just kind of zoom in a little more micro, you had the initial leg down, followed by what appears to be a bear flag, followed by an impulsive breakdown, which is still in play here. So again, the measured target would be roughly that distance to that flagpole added to the top of the flag. You want to go to all the way top of that candle. That'd be the right thing to do. But either way, it's going to take us down roughly to my next target there. I had a level 415.51. That's support. We should most likely will get a reaction there. But that flag's going to take us down, I believe, closer to this 394.56. We'll call it 395 target. And again, I trade, even if I'm not trading the SPY, I'm using QQQ as well. And it's usually the first of, it depends, but you want to see them both. Ideally, and you usually will see them both falling to a support level around the same time. And obviously, I'll give you my thoughts then whether, like I said, on SPY, I think I'll hold out. Again, I'm not in SPY. I would probably hold out based on what I've said and just ride out any counter trend bounce off 415.51 and hold out for closer to that 395 target if we start to get that swoon down. It hasn't happened yet. Remember, we still haven't taken out the recent lows, so work to be done, but everything looking good so far. Charts are playing out as they should. IWM, again, just a golden setup there with that year-long trading range right there. The breakdown, impulsive first target hit 192.15, back tested the other day, gave us that golden objective shorting op right there, back to the 209 level, and already good for about a 5% drop. And again, that was last week's candle, last week's high. And so you can see also a little bit of flagging action. This one's yet to break down. So there's our flagging action, impulsive leg down. And that should, I believe, again, I'm putting a lot of stock into my target, which is 171. Let's just see where that measures out to. Up, about on the button right there. There it is, 171. So If that flag plays out, again, I'm adding the flagpole, the distance of the flagpole to the top of the flag right there, and that should take us down right to my target there. So, and if you trade futures, yeah, I'll give you, RTY. I'll update as we get close there, but you can use the main ETFs. They're very accurate. They're going to show you the same levels, and in some cases, you probably have more traders trading the IWM than RTY. So you can look at the chart there, and as you start to get close to 171, that's where you start to tighten out stops, because we're going to have probably a pretty explosive bounce if and when, especially if that IWM target is roughly coincides with QQQ hitting the T2 on the weekly chart as well, and or SPY hitting support. Okay, so we'll see how the day finishes, but as of now, I'm liking the action I've seen so far on the 60-minute chart. So let's just roll into some of those other sectors. Their potential trading ops. The home builders is one of them. I mentioned this in the comment section last week to somebody. A lot of people, and I think on the media, they talk about XHB, because I believe that was first to market and probably has more volume in there. But XHB, it seems to me over the years, I've looked at them both, and I think it has a higher concentration of Home Depots, Lowe's, Sherwin-Williams. In other words, they call it the Home Builders ETF, XHB, but it's not a bunch of home builders. It's got Home Depot and Lowe's make up a huge, and I haven't checked it in recent years, I'll tell you, in the last year or so, but in the past I have, and it's just been chock full weighting-wise of those companies. Those are retailers. They're not home builders. So home builders and Lowe's, that's not the market they're in. So if you want to short home builders, ITB has a higher weighting, or you can go to the individual ones. But let me just show you the charts here. This is a weekly chart of XHB, and that is a nice support level. I'm going to mark this one up for you right now. There's a big divergent high, negative divergence, again on the weekly time frame. That tells me, the corrections are going to be, commensurate or in line with the time frame and the scope of the divergences. This is the biggest divergence we've had on the weekly chart, or really the only divergence in a while. This was coming right off the major drop right there, coming off the bear market lows back in 2009, and we had divergence at this point here. We had a little corrections, but again, we were start of a bull market. This is late. To say this is late stage bull market action would be the most grossest understatement. Or most gross understatement that you could possibly make. Again, because I'm considering the bull market is starting back in 2009 in COVID. Again, I'm looking, just eyeballing it, and I've made that case before. It's just a correction. It happened so fast, so quick. Yeah, 36% drop in the S&P, but less than that in QQQ. And the Fed and the government stepped in. So point being that the stage is set for a pretty big drop, and let's keep it simple. Let's just look at the technicals. If you're a bull, you buy it right now. 69, it's big support. XHB, you had a breakout right here at all-time highs, successfully back tested once, twice, nearly 3 times there, also bouncing on the 200-day moving averages. 200s were just taken out, and now we're down here testing, and for a while here just testing 69. So if that breaks, that's obviously going to be bearish for the sector. And again, this is a weekly chart, so you want to see a solid weekly close to seal the deal or help to increase the odds. There's going to be much more downside. And then just let's go to ITB real quick. As I said, that one has a little bit better weighting of the actual home builders. And there it is, just a beautiful level. I have it about 65.78, so we'll call that 65.80 or 65.70 if you want to be safe. Lots of reactions. It was an all-time high right there. There was our breakout candle, back tested for several times back then, more back tests, and lately testing that. So there's a level to watch, call to trade setup. If and when it breaks, my first target would be 58.53. Ish, we'll call that 58.50, and then 51.66, and that would be my preferred target. And what does that mean? Well, it means active trade. You probably get a bounce there, but if you're willing to, hold your nose and jump in the water, and meaning short, set your stops and let it run, I think we'll go down to 51.56, and so that would give you a drop of about almost 25% in ITB. And then of course individual home builders might have more bang for your buck there, like DR Horton, DHI, you can see the charts are going to roughly align. You got big support right there. If it breaks, this one's coming back, I think, to at least this level right here, 63.50 and the uptrend line. And so that would give you a drop of about 25% as well there. And I could go through each and every one, but that's not the point of this video. I just wanted to tell you sector, and of course ITB. I don't know. They do actually have long. They have nail and claws. Claw might be gone. Let's see if it's still around. Yeah, it's gone. A lot of the this has been the unprecedented bull market that we've had since '09, and a lot of the inverse ETFs have gone to the wayside. There just wasn't the interest in them. So there used to be one out there called Claw, which was the inverse of nail. Now what you can do, you can short nail, and you get the leverage. This one is the 3-time bull. So you short that and you got the juice if you want it. And I only recommend trading on the juice, swing trading. I'm talking about leverage if you expect, as I do, the potential for a pretty strong and mostly unidirectional drop. What does that mean? That's a unidirectional drop. That's when you want to be short an inverse ETF or long, even long an inverse. I'm sorry, short a bullish long ETF or long an inverse ETF. In other words, buying if we still had claw, which is gone now. When you don't want to be in them is this kind of choppiness right here. That's when the leverage will eat at you and get that decay. And so there's nothing wrong with being long, especially early on off a bottom. Just get out before the first big consolidation period or during a correction, because stocks tend to fall a lot faster than they rise, and you can just look at any chart and see what I'm talking about. Go to a long-term chart, weekly chart, then you'll see the bigger trends. And next up, I did a couple videos and shared some individual trade ideas on the semis. Still looking quite promising. SOXX is your semiconductor ETF. I shared my targets for you there. S1 is really, S1 means support one, the first support level from this point. And so when we zoom in tight here, and we can even turn off all the lines for a second, you can see a similar setup in the semis. Had a big thrust down. Appears to be flagging, and right now it just appears to be cracking below that bear flag. So again, no guarantees, but the ideal scenario would just see this week down, red close in the markets. And again, as I like to say, the redder the better, especially coming out of a flag, because that's the nature of a bear flag. The move out of the flag once it breaks down, and the drop, subsequent drop, is usually roughly equal to the flagpole, meaning very pretty swift, almost straight down drop. And so that, again, let's just put the levels back on and mark it up and measure out, because I don't think I did this in the video when I covered it recently. There's our flagpole, top of the flag, and look at that. Brings us a little bit above my target right there. And you can even see I could move that line or add another one right there, because there's a couple candles that I missed right there at the bottom of that candle. One there, so that would be about 387.50. You can either the flags are just a rough approximation, and that's where I think the semis are going, the next stop. And then ultimately I still maintain my longer term T2 down here, which is about 271, and or that intersecting uptrend line. So again, to kind of recap what I've showed you when I covered it before, hit down there, hit that target, get a bounce, which could take weeks or even months, maybe, we'll see, and then ultimately work our way down there. And I know my calls are usually way more aggressive than just about anybody out there, and trade it as you want, don't trade it, but that's a cut the semis in half right there. And as I talked about, if you trade on the juice, you're going to have this is the 3-time short semiconductor. Just if it tracked perfectly, then you're looking at 150% drop off the highs. But obviously, if it does what it's done in the past and what these things do, just the way they're engineered, you could probably expect better, well north of a 200% return if that target's hit. Especially if you can hit that first target on the weekly chart on SOXX, maybe sidestep the first bounce, get back in. That's what I like to do with these things. So again, just showing you some of my favorites. Let's see here. Next up, I covered home builders. REITs. Let's revisit the REITs. This one was shared with you back here. It's a short trade idea right there in the actually before we started flagging. I shorted this one, put it on the site as a short right about here, and very well in knowing that I was shorting, and I even said it. You can take it, not take it, but I added it on. It was aggressive because it was before we even broke down, and I shorted in anticipation of breaking down. That's somewhere else I differ from when you read a lot of the trading rules. They'll say wait for the breakout. Try to guess what's going to happen. And at times, if I think the chances of breakout and the risk reward profiles are attractive, I'll take a short or a long position in anticipation of a breakout that hasn't even yet happened if it appears to me extremely likely to happen. And that's what that was. And we flagged right there. It was a beautiful, beautiful flag. There was our flagpole, textbook bear flag, and a textbook move out of that bear flag, nice impulsive. Hit our first target there, and then hit our second target, at which point I said a bounce was likely. We bounced. Came back, tested around the first target level, and we're back to T2. Why am I updating it now? I'm not highlighting a past trade. My point here is to say that's it. The multiple targets are listed because I believe on the initial tag of each level a reaction is likely. There's your reaction. We already got it. So therefore, we don't need to have another one. And based on where we are, I don't think we will. Yeah, that's a beautiful support level. That's why you got a nice reaction. That's why it was a second target when laid out when we were up here. Look at that, boom, 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 boom. So now we break it, and it should open the door to T2. There's a little reaction there. It may zigzag. You probably get your zigzag somewhere in the middle of that move down, but I think it'll open the door for a move down to T3. And possibly blow through there and hit my final target, which is T4. So I still like it, and I also laid out for you if you want to trade with the juice, SRS. It used to be, no, this one was always 2-time. They had a 3-time, let me see if it's still around. They had DRN and DRV. DRN was, the bull, 3-time bull real estate, and then the DRV I think went to the wayside. No, there it is. You can still trade this one if you want to really leverage up. 3-time bearish REITs. But again, SRS, whatever. You can use 200% leverage on SRS or 300 on DRV. And then there's a rough long-term target zone. But again, I encourage you to look at, even if you're using SRS or DRV, look at the chart of IYR, because that's tracking the sector itself without any decay or distortion in the charts. So that's a lot of upside potential on that one, or downside if you short IYR. One that I just wanted to mention today because it's cracking. I know oil just doesn't want to stop. However, the energy sector has just triggered. It just broke down below this little minor uptrend line. Nothing big, but you have a little breakdown and back testing, and you have divergence. So I think the energy sector is ready to roll over. It's also a big resistance level in XLE, and we'll probably get a pull down here, move down to that uptrend line, the T1 area, T2, you can see all this. And at that point, oil will most likely have rolled over if I'm right. Because if the stock market takes that next leg down, you are certainly going to start hearing increased rumblings of the impact the drop in the stock market will have on the economy. That's where a lot of analysts, they can't tie in the bigger picture. They're forecasting right now everything. Demand is surging, super strong. Everything, all the economic indicators are firing. On inflation's the biggest risk, and the worry about the Fed raising rates. But again, it all ties in together. So Fed has no choice but to raise. It's now a matter of how much, how fast. Are there going to be any intermeeting emergency rate hikes? Is it going to be 50 basis points at the next meeting? Those odds certainly shot up last week. And again, then if it has an impact on the markets and the charts begin playing out, then you're going to have the wealth effect going in reverse now with the stock market dropping. Consumer sentiment plummets. Consumer spending therefore drops. And all of a sudden you start getting a revision of estimates. And the analysts that, again, they're just basing things on the recent numbers and the previous numbers. And I try to look ahead and see what kind of impact that'll have. So, hey, it either all happens or it doesn't. Right now, everything looks. I keep getting check marks along the way, so I'm gonna stick with that longer-term bearish outlook for now. And just want to mention that XLE and the XOP, you can short that, or you buy instead of XLE, you can buy Um, DUG, or which is a two times short energy sector. And then if you want to go with the XOP, which is the oil and gas exploration and production ETF, DRIP is your inverse ETF. I think it's two time leverage. I'll show you that in a second. But there's your bearish rising wedge. See, last time you had a divergent high was right here, divergent high, and there's your current divergent high, and it's just above resistance. So this was a false breakout. If this one fails, you'll also take out the trend line and fail the breakout above 105 right there, and that should take us down quite a bit. And again, you can leverage up or buy. If you don't short, you can just buy drip. It shorts the energy sector for you. Divergences have been building, building, building. And you could probably throw in a little trend line right there as well. It is the two time short. There's your little bullish falling wedge pattern right there. So boom, pop that. Well, you could use that as your first target. It's a downtrend line. And then next stop would be right around there. You probably pull that line now down to the recent highs. You're going to get some decay and distortion in this one over time. So there's my first target zone. We'll call it 625 to 670. And then T2, might have to pull that line down at this point down to about 840-ish, maybe, something like that. All right, so there it is. Drip. All right, that covers energy. And, of course, you can also short the other sector, XES, which is the oil and gas equipment and services ETF. And same thing, you got a nice little trend line there, which is probably about to pop. You've got resistance. We're already at resistance. There's a previous reaction high right there. So let's leave that line there and move this one up. There's resistance, and you got it. Negative divergence. So energy looks like it's about to get roiled, and it looks like a nice trading op. Where would I swing it down to? These are old lines I haven't even touched in a while. I'm going to tweak that one a little bit. 55, just over $55, and then ultimately I think we'll swing down to here. I'm going to pull this line down a little bit. No, you know what? I'm going to make it a zone for you. Target zone runs from about 47.12 down to about 45.48, and that is my preferred target zone. In other words, if you don't want to try to game a counter trend bounce that may or may not happen, that's the drop I'm looking for in SES, and it's going to take us down again. And that's at minimum. It's going to take us down about 25%. XLF still looks extremely toppy to me, and we had a more recent sell signal. I think I highlighted it a week or so last week. Broke that minor uptrend line. See these little minor trend lines? But the bigger picture, you scroll back here, we broke this trend line here, and you had a series of divergent highs, and that's a breakdown, back test right there, and now we broke the minor trend line, which gives us a sell signal. That yellow line should do the trick. That's the magic number. It's an objective short now, I think, all day long right now. Minimum targets down to 37, but bigger picture, I think 37 will go, and then we'll finally hit my second and third target from back here. That's where I called a major top on the financials. And as I said, there's a difference between early and wrong. I always say that in trading. Being wrong means you had a call on a trade and you were stopped out because the trade exceeded any reasonable stop loss level using good risk reward ratio, at least 2 to 1, ideally 3 to 1. And so I talked about that back then. We went down, we hit my first target, we bounced, we made a marginal new high, but still well within the realm of where I think this one's going. And again, I'm going to turn my focus to the weekly chart if and as this starts to play out. So we take out 37, we'll run down 30, T2, T3, and then you look at the weekly chart here, and the potential is to come all the way down there to that 31.35 level, which would be a total drop in the financial sector, correction of about 25%. That number keeps popping up, by the way, that 25% number. So if you're looking for kind of what the next correction, what the correction is going to likely play out for, at least in many of these sectors and the broad markets, at which point then we'll be looking most likely to go long, cover all shorts, and position long for some nice swing trades on the long side. And again, I know I'm getting ahead of myself, whether or not that happens. If it happens, and the chart's confirmed to go long, cover, and reverse from short to long positions, Whether or not that proves to be just a longer term bear market rally, which I suspect we'll see. I keep saying that because if assuming we get down there, assuming XLF does this and all the other things I've been showing you, at this point, the long-term charts are going to have changed. We might get some long-term indicators rolling over all the way out on the monthly charts, indicators that are still clearly bullish at this point in time. And so again, we just have to see if and how this plays out. And at that point, again, I still think there's a good chance we'll be able to game a tradable bounce. It'll be a matter of, do we position long for the next bull market, the next run to new highs and beyond, or do we just at that point in time want to swing or trend position long for a counter trend bounce with another leg down to come. Again, getting ahead of myself, but this is what I like to do, and kind of helps formulating the bigger picture. Then helps you kind of hone down and decide, all right, how to what to look for on the shorter term time frame, shorter term charts. A couple more and we'll wrap it up here. So that's the financials. I covered energy. Last but not least, I wanted to talk on the bond market. All right, we all know what's going on with the Fed raising rates. TLT bond prices move inversely to rates, so long-term rates across the board have been rising. This is TLT. I'm just going to run through some of my I have a folder with various bond ETFs and rates too. TYX is the yield on the 30-year bond. So here's what we're watching for. So the 30-year has been going up, right? And it actually just took out this downtrend line. So there's a breakout. And, it may continue to go up, but I'm starting to see divergence here. And what I suspect will happen is it's tough right now. The bond market's tough for me because I'm struggling with two big things. Again, assuming my call on the stock market's right, we're going to go down. Economic growth is then going to slow. That in itself should cause longer term rates, especially the 30-year bond, to fall. In a normal world, that it would. You would see 30-year bond yields go down, and that means TLT, the bond ETFs, or ZB, the bond futures, would go up. But this is being offset at this point in time by inflation. So we may be looking at the first stagflationary economy in decades here. And if so, what happens is stagflation means inflation's pushing the long-term rates up, even if the economy's not growing. So, I'm kind of, as far as trend or swing position, I'm analyzing the bonds right now mainly to just kind of get an idea what's going on in the stock market. You know me, I'll always share a tactical trade on treasuries or any bonds, corporates, if I see it. But right now I just wanted to kind of talk about what I'm seeing here. And let me just continue on. I'll get to my point. There's TTT, the short 20 plus year. If you want to short the long bond, 20 to 30 year bonds, this is your ETF right there. But what happens here, let me go back to TLT. So here's TLT. We'll go to weekly chart. Bonds have been falling. And I talked about this in 2018. I called for a pretty good correction. We nailed that in the fourth quarter of 2018. And I remember at the time, the media, in their job, believe me, they can slap, and they always will slap on a cause for every rally and every correction, whether it has absolutely nothing to do with the market. Rarely they come on TV and just put up their hands and say, well, Dow had a huge drop today. We have no idea why. I remember back in the fourth quarter 18, the majority analysts and even the pundits on TV, they had no idea, and it was technically induced. And so, but what happened there is, and I talked about it, we had bonds falling and the stock market falling, and that's a bad situation for pension funds, especially pension funds, hedge funds, things like that, and even individual investors, because that whole asset allocation model, the Fed's really screwed the investor, in my opinion. They took rates down near zero to force money into the market. They pumped the markets full of liquidity, number one, but they even when Greenspan was chairman, he said it directly. There's no qualms about it. They bring rates down low to gun the stock market for one of the main benefits to get the wealth effect going. People feel richer, and they have more money in their 401ks and stock accounts. They're going to go out and spend. Now, the downside by doing that, bringing rates down, what it does, it chases money out of safe haven investments. So more conservative investors, think retirees, think pension funds, their conservative part of their portfolio, they force that money out of safe havens like bank CDs and treasury bonds that are secure into riskier assets, REITs and junk higher yield bonds, things like that. And so now what happens is when, because of where we're at with interest rates coming off a bottom, a floor of zero on short-term rates, and really nowhere for bond yields to go but up, meaning bond prices to go but down, it's really a dangerous situation now that the gig is finally up and the Fed's going to be taking away the easy money spigot, shutting that off. It makes it very hard for institution or any investors to balance risk, because the old rule, when I was back in my former life, I was a stockbroker, financial advisor. One of the first things we learned is the asset allocation model, and the old rule of thumb said take the number 100 minus your age, and that's the number you should have into stocks and bonds. So if you were 20 years old, you might only have 20% of your money in conservative bonds, and then you'd have 80% in stocks. And the thinking was that stocks tend to go up when stocks and bonds tend to move inverse of one another. Bonds produce lower returns, but they're more steady. And usually in the past, for many, many years or many decades, when the stock market dropped, bonds went up, and that's because institutions will flock to treasuries as a flight to safety instrument. But that whole asset allocation thing has just been turned upside down now, because I've talked about this for quite a while, saying this is the worst outlook in history. Can you go back and you can look at long-term interest rates? We're at a floor. We're at the end of a secular cycle, a secular bear market in interest rates. This is the 30-year bond yield. This is when it peaked back in the early 80s, late 70s, for Carter transitioning over to Reagan here, and we entered a period of steady low rates. And in fact, the rates, I've covered it many, many times over the years, we're in a nice, well-defined down price channel, and then all this artificial manipulation of rates by the Fed. That was the first quantitative easing in 2008. You see these other rounds of quantitative easing that took us below the channel, and then the all-out complete nuclear option when COVID hit, a complete overreaction, tremendous, taking rates down to zero. Also, intense manipulation of the bond market, buying bonds, not just treasuries, mortgage-backed bonds, buying corporate bonds, even junk bonds, Fed invoking emergency charters. But look, I'm a firm believer in reversions to the mean, and also that no trend lasts forever. Again, this is a secular bear market in bonds and rates, which is a bull market in bond prices, and we hit the floor, and there's nowhere to go but up. We can stay down here for a while. That's possible. But again, the outlook is over time, if we enter a new secular bull market in rates, that's a secular bear market. Remember, TLT bonds go opposite the price of stocks, and that's going to make it extremely difficult for institutions and individual investors to have a well-balanced, diversified portfolio, because you're just going to be losing money for years to come on bond trades. I mean, that's the way it works. Bonds are TLT. If you had treasury bonds back here when COVID hit and you were buying them at that point, they've already dropped 25%, and the yield on those bonds was what, couple percentage points, a few percentage points at most. So those are big losses on treasury bonds, and they're going to continue lower ultimately, I think. Here's an uptrend line on TLT. All right, let's get away from treasury bonds for a second and just look at the other ones. This is what I wanted to get at here. Short-term bonds, or junk bonds, we're going to get to in a second, but I wanted to show you the short-term bonds, SHY. This is SHY, the 1 to 3 year treasury bond ETF, so it tracks the shortest term bonds. See, this is what happened when Fed took it to a zero interest rate policy. The existing bonds were worth more, and then you hit a ceiling there that really the short-term bonds couldn't really go any lower unless we went to negative interest rate policy, which we weren't going to do in the U.S. The Fed made that clear. Thank goodness, because it's not a good policy overall. And then we had a very well-defined channel ever since COVID hit, where we were gradually walking up the shorter-term rates. But look, this is where the bottom just fell out. We broke the channel, and it's been a free fall. And this is the inflation. This is where the markets realized that Powell didn't know what the heck he was talking about, that inflation was not transitory and was here to stay and only getting worse. And it's been a panic sell-off in short-term bonds, meaning the yields have been going up. We are at support. There's an idea. If you want to buy any kind of bonds right now, with the safest bet would be the short-term treasuries. We're at a pretty decent support level, so we'll probably bounce soon. Um, and what I think that'll be, I think when the market throws a hissy fit here soon, if I'm correct on my next leg down theory, it's going to force Powell to not be as hawkish as he needs to be, if that makes sense. Might decrease the odds of a 50 basis point or an emergency rate hike. And so therefore, if that happens, you'd probably see a little reprieve here, a little bounce in short-term bonds. But let me show you the other ones. Let me show you what's going on in the corporate bond world. I'm on weekly time frames, guys, by the way. This is bigger picture stuff. These are muni bonds, or muni bonds. I put a post a couple years ago back here, or here, and I called it the muni bombs. And I was expecting, and we got a big drop here. You can see a divergent high. This seems to be a pretty significant resistance level or support level that was broken back there as well. I'm going to add that to my chart. I didn't mean to put that one on. Grab that trend line there, or horizontal line. And so you can see munis just have been getting pummeled lately. And again, what this does, it really skews or breaks, and this is what I talked about back in 2018. It breaks that risk, those risk protocols or safeguards in institutional accounts like pension funds. They're taking big losses right now in their bond holdings. Whether they have treasuries, safe haven treasuries, whether they have relatively safe haven municipal bonds, they're getting clocked. In other words, they're losing a lot more in principal. Muni bonds, I don't know what the yield, you can look it up, was probably at best 3% or so. And just in the last few weeks, it's already dropped 3.5%. Since the recent highs, it's dropped almost 5%. And what does that mean? It means in just a matter of weeks here, you lost more in principal than this thing can possibly pay in interest over an entire year. And that can just keep going down. And the more that goes down, if MUB comes back to the bottom of this range, which I have little doubt that it will, that's a 10% drop. It's going to wipe out years of interest collected. And then what's the point of even being in those bonds? So it's almost a surefire way to lose money, and there's a ceiling right there. So that's the outlook. It doesn't look good. We're coming up to a point. I wouldn't short them here. We're coming up to support, just like I showed you on SHI. So there's maybe a little downside on the longer term muni bonds here. Short term bonds are coming up on support, but bigger picture, this doesn't look good. I think we'll soon get a little reprieve and then continue lower. LQD, this is one to watch. Remember, we had two excellent shorting ops on LQD back when COVID hit. We got in early before the market realized what was going on. I saw the stock market drop, and we shorted, there on the break of that trend line. Cover down here. The targets are gone off this one now. Where did they go? Oh, there it is. Here it was. This was the second short entry right here. First short entry was there on that break of that trend line. Boom, boom. T2 hit T3 right there. And then we shorted again here on the bounce back and hit T1. That's where and then the Fed stepped in and invoked those emergency charters, emergency powers that allowed them to actually step in and buy outside their normal purview or whatever it is, allow them to buy corporate and junk bonds, and that's what they did. And so they artificially supported a market that was set to just collapse. And then, good thing so they did. But then look, technically speaking, that became a very significant level there, about 128, and it recently broke. And look what's going on with corporate bonds. They are falling off the highs. Again, that was an artificial spike high, but it was about less than 2 years ago. And LQD, which again, if I didn't clarify, is the investment grade corporate bond ETF, not junk bonds. It's dropped almost 11%. So again, it's wiped out years of interest, and most of that slide has just recently occurred. So this is what I'm saying here. These are bad things for the market, and you're seeing, although you're seeing investment grade treasury bond yields rise, you're seeing low grade yields rise faster. So finally, that brings us to junk, JNK and HYG. Those are the junk bond ETFs, and you can see this one. Again, it was all priced in here. This all goes into my analysis. This was a divergent high right here, negative divergence. There was a little trend line that broke. It's been moving lower. We had pretty good, decent support there, about 105. Boom, hit it, had a little reaction, smashed through it. And this is going to come down. This is, maybe a kickback rally, maybe not. But these yields are falling. Junk bond yields are rising faster than investment grade yields. That means credit spreads are widening, and that is something that I've looked for in the past. I watch for problems in the economy, and you're certainly seeing it here. You're seeing a flight out of a lot of money coming out of high yield bonds, and that means the yields are shooting up. HYG is at support now, so again, we're coming up on support on quite a few, but I believe there's going to be more downside whether we bounce or not in the corporate bond market. All right, we're going to wrap it up here, and I'm not throwing out the bonds really as trade ideas. I just think there's more meat on the bone on the equity trades. So, but I am watching this. I want you to know that I watch this, and if I see signs of improvement, something that contradicts or is more bullish for the economy, because a lot of seasoned traders will watch the bond market for clues, early signs, warning signs for cracks in a rally or a bull market at the top, or they'll look for signs of improvement, stabilization during a bear market in stocks to say, hey, the bond market's signaling things are turning the corner, and that is often an early cue. So I just want you to know I'll keep an eye on that, and just wanted to show you what I've seen lately is not pretty. And again, it breaks those risk models that a lot of the institutions have, meaning they're going to soon need to really start selling equities to plug the gaps. They cannot afford. They can't sit there like a retail investor with the hope and pray strategy, which happens during bear markets. And you see it drops 15, 10. They think it's a correction. They're buying the dips. 20%, they're 30, 40. It keeps going down. They're in pure panic mode. At that point, a lot of retail investors will just freeze like a deer in the headlights, watch everything go down, down, down. And, if you've got a 10-year time horizon, great, plays out, you get back to where you were. But institutions, they can't do that. They cannot sit there top heavy in equities, which I can tell you they have been in recent years. I've read a lot on it. A lot of institutions have shifted because pension plans are grossly underfunded in this country. It is what I believe will be a crisis at some point, and they have shifted in recent years, more and more, taking on more and more risk, more and more equities, more and more private investment, real estate, things like that, which is not good. And so they're going to have to start to reduce that exposure, especially if the stock market continues much lower from here. All right, I'm going to wrap it up there. A long video. Just want to kind of air out all my thoughts fundamentally, as well as what I covered earlier on in the charts. This has been Randy Finney with Right Side of the Chart. Have a great day.